Welcome back to 2020 Trading. Today in this video, I'll be talking about trading psychology. I'll be telling you a story that happened back in 2019 and how I realized something I didn't know about trading psychology. Trading psychology, what I thought it was prior to that date, I thought it was about me. It was about what I'm thinking. It was about my psychology. So you're probably thinking, yes, it should be about you, right? It should be about your psychology. But actually, what I realized is that trading psychology is not about me. It's about the other market participants because they're much bigger than me, right? There's thousands of them. There's only one of me. So it doesn't matter so much what I'm thinking or what my bias is. What matters is what is the majority of people, what are the majority of people thinking? What is their bias? What is their psychology? Now, this is going to be the first in a series of videos that covers trading psychology. So this is the first one. If you want to see the other ones as well, don't forget to like, comment, and subscribe to the channel so you don't miss those videos. All right, let's get into it. Back in 2019, I think it was early 2019, I made a trade on a particular stock. Now, this stock had reported earnings. Okay, so let me explain. So companies in the US have to report earnings every quarter. So that's 4 times a year, right? So this company had reported earnings for the previous quarter. So I think it was a quarter, October to December 2018. All right. So they reported its earnings. I think it was around January 2019. Now I looked at this earnings report and it was so good. It was fantastic. This company was a cloud company in a cloud space, a software company, great company in a great industry, and it was doing really well. So I looked at the earnings report. The earnings report beat analyst expectations, analyst estimates. So analysts would normally have the estimates of what they would say, okay, we think this company is going to report X amount earnings per share or X amount revenue. And so the way you know whether a company has done well is if it beats the analyst estimate. So this company beat analyst estimates on both fronts, on earnings and on sales. And year over year, they also grew revenue and grew the earnings. So I'm looking at this company and I'm thinking, this is a buying opportunity. I was like, I am so going to buy this stock. I'm thinking, I'm going to make some money. I'm already thinking about what I'm going to spend the money on or what I'm going to save the money towards. I was going to save the money towards buying a car, right? So for me, it was just all I could think was just how much money I'm going to make. But here's the thing, to be fair, I did my due diligence. I did my fundamental analysis on the stock. I even listened to the conference call of the company. Okay, so what happens is when this company report these earnings, they also follow the earnings report with a conference call which is done via webcast, and analysts then ask them questions, basically drilling the CEO and the CFO, whoever it is that comes to the conference call. They drill them and they really ask uncomfortable questions. So I was in the conference call. You can listen to the conference call live or you can listen to it on demand. So I was actually live. I was taking notes. I had my journal. I was taking notes. I was very convinced that I had seen a fantastic buying opportunity. For me, this was like a no-brainer. This was like, this is my money for the month, right? Anyway, so the day comes, so they report earnings overnight. Now, overnight, the stock gaps up. Now, what happens when the stock gaps up? It means that the stock price opens higher than its closing price. So it gaps up about 10%. And there's something called a gap and go strategy, whereby a stock gaps up and then when the market opens, it continues to go higher. So for me, I say to myself, this is a fantastic, typical, perfect gap and go strategy stock, whereby I'm going to buy the stock and then it's going to continue higher and maybe add another 10 or 15 or maybe even 20% on the day, because we were seeing those types of moves at the time. Okay, so the day comes in the morning. I am ready to press the buy button. Market opens. I'm pressing the buy button. Boom, 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 getting in. So as I'm getting into the stock, shocker, this stock starts to go down. It's tanking, like seriously going down. So I'm looking at my charts, right, just to make sure that I was buying the right stock. I'm looking at it. It's like, yes, it is the right stock. I look at my order entry. It is the right stock. So I haven't made a mistake, right? So, but what's going on? Anyway, I'm like, Okay, let me double down. I double down, right? So I buy even more. As I'm buying more, it's heading down. Like you couldn't stop it. Okay, so I decided, okay, there's something going on here. I don't know if people did not see the report, or maybe people did not listen to the conference call, but for whatever reason, okay, I think I went to look at the news to see if there's maybe they've released some negative news in between the time that they released the report and the opening bell. I didn't see anything. Anyway, I got out of the trade. I cut my loss. But after that trade, I realized that there was something that I needed to learn that I hadn't learned. Because I said to myself, if I cannot make money buying a stock that comes out with fantastic news, a great catalyst, great earnings report, how can I make money? How? Like, if I can't make money with good news, how am I supposed to make money? If I'm losing money buying a stock, it's not even going sideways, it's going down after reporting fantastic earnings. Anyway, I knew I had something to learn. But you know, when you're looking for an answer, but you don't know, you're looking for something, but you don't know what you're looking for. But you know that when you see what you're looking for, you'll recognize that that's what you're looking for. Yes, that's where I was. I knew I needed an answer to that question. Why would the stock go down when it reported good earnings? Why? It's supposed to go up. In theory, it should go up, right? So that was the question that I had in my head. And that question was with me for a long time, for weeks, maybe even months. I was seeking the answer. And I finally found the answer. And guess what? I'd watched a YouTube video, right? I can't remember, but I watched a YouTube video, and then I was reading through the comments, and I read, and somebody said, just randomly, a person just said that the charts you see are a graphical representation of people's greed and fear. Basically, it's a graphical representation of people's emotions. And that comment, as short and as crisp and as succinct as it was, it struck a bell straight away in me. Because I've always looked at charts, right? I've always looked at charts. Everyone, every trader, every investor looks at charts. But I've always looked at charts as just prices, just numbers against time, prices against time. Now, I started to look at charts very differently. I started to look at charts as people's emotions. When the stock price is going up, euphoria and greed is coming in. And when stock prices are going down, fear of losing is going out. And those are the emotions that drive through humanity. We all have the same emotions. And so we all think alike. And so that's why when stocks go down, they go down too much, because everybody is feeling that fear. The people who are able to make money are the people who are able to understand the difference between fear and greed, and be able to marry the two together and pair the two against each other. Anyway, so what I did was, then I went back to that stock that I had lost money on, to go and look at the chart in a different way, in a different light. Look at the chart not just as numbers plotted against time, but as people's emotions, people's greed and people's fear plotted in over time. And then what I realized kind of like blew my mind, because so I look at the chart, right, the daily chart, and I realized that prior to that time where they reported the fantastic earnings that was meant to give me a ton of money and help me buy a brand new car, no, not a brand new car, but you know what I mean, buy a car, right? I looked at the daily chart and I realized that the stock had done about 30% in the 1 month leading up to the earnings report. And plus the 10% which it gapped up. Now the stock is up 40% in just a space of a month. By the way, the stock market in general goes up 14% in a whole year. So when you get 40% or 30 or 40% in 1 month, that is fantastic, right? So now, because the stock had done that great move in that short amount of time, what happens is this: people who got in early, who got in 3 weeks before, 4 weeks before, 5 weeks before, they're ready to take profit, right? They're ready to take profit. Now, especially when you wake up in the morning and you've just been handed an extra 10% overnight, you are eager to lock in the profits, right? So this is what happened. Now, me coming into that trade and not looking at the chart and not thinking about the psychology behind the trade and not looking at the psychology behind what other people are doing and what other people are likely to be thinking was the mistake that I made as a newbie, right? So as a newbie, what you do, you end up buying the top and selling the bottom, which was what I did, and which is what most newbies would do over and over and over again. And that's why up to between 95 and 99% of new traders will lose money, right? So that's the story. I got into that trade, I lost that money, I went back, I looked at the chart, now I understood that the psychology of the trade was that people had already made 40%. It was time to take profit. So what I would do today, if that was me today, was I'm not going to buy that stock. You know why? Because even though the stock came out with fantastic earnings, it was already priced in because of that run up. It was priced in. So what I needed to do, even though it was a fantastic company in a good space, good fundamentals, you have to wait for the stock to pull back to support. Now you can buy low so you can sell high. So that was a lesson for me. And for me, that was an aha moment. In my trading career, in anybody's trading careers, you have many aha moments where you realize things that you didn't know before, things that you were looking for answers to. And that was one of my aha moments. So if you're watching this video, you better learn that, you have to learn that charts are about emotions. It's about fear and greed. Look at the chart in a different way. Don't just look at it as numbers. Don't look at it as, oh, it's gone from 9 to 10, it's 11. Look at it as it's going down. There's going to be a lot of fear around the world. Everybody who's looking at that stock is feeling fear. People is going up. People are feeling greed and emotion. So again, buying low and selling high is about thinking about how the psychology applies to the trade. Anyway, I hope you enjoyed the video and you learned something. If you did, don't forget to like, comment, and subscribe so you don't get to miss the next videos. Also, turn on the notifications so you get the alerts when I put up the videos. All right, thanks for watching the video. I'll see you at the next video. Peace.